back to another episode of the Old Fashioned Real Estate Show. I'm Brian Leverage.
Yes, you are.
You're
Jeff Holst.
That's right.
Thank you for agreeing. So today we have a really great topic. We're going to talk about risk mitigation and the things that you can do to reduce your risk and get a better return as a result of that. And we're going to do it right after this.
Welcome to the Old Fashioned Real Estate Show, where hosts Brian Leverage and Jeffrey Holst pour our old fashioned real estate advice.
Risk mitigation. What are the components of risk? Those are the things that we're talking about today. Mm-hmm. Would you like to start, or would you like me?
Jeff, why don't you run with this?
I thought you might say that
You're
for
gifted.
some reason.
Yes.
All right. So what I think about when I think about risk, and this is something Brian and I have talked about.
It's a great board game, by the way.
It is a pretty good board game. And by the way, Hasbro, if you want to sponsor our show, we're happy to accept commercials.
Yes, a bourbon-based board game would be even better.
That would be awesome.
That was a tangent. All right.
Yes. All right. Let's get back on the topic here, Brian. All right. So when I think about risk, not the board game, but when I think about risk in general, it reminds me of how investment returns are calculated. Right, because I think that's really the main thing. Like, there's this general understanding that a riskier investment gives you a higher return. Like, people understand that, I think, intuitively, because it's repeated over and over again. But for some reason, when you think about cap rates, people don't always make that connection. So a capitalization rate is just the return that you would expect on the investment. We've done a whole episode about that.
If you pay all cash.
Yeah, right. Excluding financing and income taxes, this is the return you would get. Now, if you're in a 4 cap market versus, say, like a 10 cap market, 10 cap markets are going to be arguably significantly more risky than a 4 cap market.
Yeah.
Now, there are reasons you might want to be in a 10 cap market. For example,
Cash flow.
Yes, cash flow instead of appreciation. But that 4 cap market is arguably much more stable.
Yes.
And long-term viability is going to be there. And generally, the lower cap rates are newer buildings, better products, better areas, all that kind of stuff. Mm-hmm. So when we think about that, though, like, how is the market making this determination that matters? So there's really 2 components. This is just basic finance theory of a return on any investment. It applies to investing in real estate, but also stocks or whatever else. You have a risk-free rate of return, which is generally defined as the treasury yield. And then you have a risk premium. So all investments are made up of those 2 components. So that 4 cap property, if the risk-free rate of return is 3.999, right, then the risk premium is very, very, very small, right, because it's a 4 cap property.
Yeah.
Right now, I think the risk premium is about 4. That's around where it is as we film today, early July 2023. But the difference between the risk-free rate of return and the total return on the investment, or the cap rate, is the risk premium. And so that's what I want to talk about today. Is sometimes accepting a higher risk premium can be extremely profitable. But it's also relatively more risky. So that's why we wanted to talk about methodologies that I use and that Brian and I use together to mitigate our personal risk and still get compensated that market risk rate.
Yes.
Because if you can get paid for risk that you're not accepting, you're going to win. This is what the hedge funds do, right? They use other people's money, and they have a very sophisticated risk mitigation strategy. They're not looking at how much return they can get. They're looking at how can we reduce our downside risk and still get paid the market return. Mm-hmm. And we can do that actually fairly easily in real estate investing because it's a very inefficient market as opposed to the stock market.
Yeah.
So ways that we can mitigate risk personally. Brian, would you like to take the first one? I have none written down. You just have to come up with one off the top of your head.
Knowledge.
Knowledge. I love it. That's actually exactly what I would have put first.
Mm-hmm. What I mean by that is it's just learning and doing, right? You know, so with experience comes knowledge, and with more experience comes additional knowledge. And so, you know, you might start out doing a smaller asset like a house or a duplex. I started that way, like I'm sure probably most of us did. Now, when we move up into apartment buildings, it's a little bit different, right? Like, we've done very well buying, 20 to 50 unit, mid-size, as we'd say, multifamily apartment buildings that are typically C-class properties in areas where they are the areas themselves are maybe going from C to B.
Right.
Okay. In a general sense. And so we buy them, and again, if you're looking at you're coming in your entry cap on it, and you're going off the actuals, they're not great deals on
Right.
paper. But then this is where the knowledge comes into place, right? We know in any area within the markets we invest what properties are going to, what 1 beds, 2 beds, etc. are going to lease for. Okay. We also have a really good understanding of construction and its costs and everything like that.
So I think you're talking about 3 different risk mitigation strategies all wrapped into one.
Yeah.
Right? So the first one is just general market knowledge, right?
Yeah.
You're talking about, I understand North Georgia, near Chattanooga, really, really well. I have a bunch of apartment buildings there. I know what stuff's going to trade for. So therefore, I'm taking less risk than, say, somebody from California that's used to paying a 4 cap. They show up and they're like, oh my God, it's a 6 cap. It's got to be a great deal. Well, that might be true, but also might not be true. Right? And if we take that to a completely different market, like one that we're not very familiar with, like say we want to buy in Nebraska, like that's a real problem because I don't know what cap rates are in Nebraska. So that's what you're talking about first. That's the first risk.
True, and to expand on that, even within a market, there are good areas, bad areas, right? And so
you can get hyper localized.
Using that same 6 cap rate, right? Would I pay a 6 cap for something in North Chattanooga, which is an area that's appreciating? It's there's high demand, good schools, everything else, versus say an area like Alton Park here, where it's the antithesis of that.
Yeah.
Like,
So that's right.
I'd pay 6 cap over here in North Chat all day long, probably, but in Alton Park.
Yeah, so that is market knowledge, right? Like, and I've said this actually recently at an event in Puerto Rico. If somebody from the mainland who's never been to Puerto Rico buys like a random property in Puerto Rico at a 20 cap, that may sound really good, but there are places in Puerto Rico where you don't want to buy a 20 cap property because it's not really ever going to give you any return, right? But if you have developed knowledge about the market, you can pick up 20 cap properties that give you a 20% return with much less risk than that. And that's that first one. So that's the first component of what you're talking about. The second component of what you're talking about was like asset-based knowledge, which it's knowledge, but it's about, I understand how mid-sized multifamilies in particular, how C and B class transitions work. You can get more and more specific. That's what you were describing there. And I think that's a very useful risk mitigation strategy. So number one, market knowledge, and that can be super hyper local, like down to the street and the block. Like, we have a street in Chattanooga that we know really well, where we buy duplexes. I don't normally buy duplexes, but if they come up on that street, I'm at least going to consider it, because I know that street really well, right? The second one is the asset-based knowledge. This is why we don't buy duplexes. We know a lot about mid-sized multifamily. And that doesn't mean we don't know about other stuff, but that has been one of our primary targets of investment.
And strategy, too.
Yeah, right. And it's also a strategy-based decision. The third thing that you were alluding to is actually scale, right? So one thing that you've done is you've built, and that's knowledge as well, but it's you have contractors that you work with. You have HVAC guys, you have paving guys, you have, all of these different people, but it's not only that, it's also real estate agents, bankers, all of that networking stuff. Putting together that team, that is a way to mitigate risk, and it takes time and effort and energy, and that's probably the underlying risk mitigation strategy is you have to put energy in. That energy could be through walking a neighborhood, it could be through going to real estate meetups and meeting people, it can be making connections with bankers, it can be just spending time in the market, it can be making investments and the knowledge you get from that, it can be from watching our show.
Yeah.
You're mitigating risk right now by getting a better understanding of this particular concept. Now, it might not make a huge difference in the micro sense, but in the aggregate, all the stuff that we're doing is effectively helping us to mitigate additional risk.
Yes.
So, other than those strategies, can you think of any other things that you think about when you're looking at real estate investing and how to mitigate risk?
Well, there's also sources of capital.
Sure.
Right.
Which I think this is like building a brand and being able to raise money like we do, to take in partner capital to diversify our capital exposure risk. That's part of it. But you also have the relationship part of that with bankers. If you have good relationships with bankers and you know what kind of financing they're going to offer you, then when you go to make those offers, you have a better understanding of what's going to work for you and what's not going to work for you.
I mean, you were just talking a few minutes ago about hedge funds and them limiting the downside. You know, partnership investing in real estate is pretty much that same exact model, because you're hedging your downside risk, right? Because you're sharing, you're basically that risk is getting spread, and then but it also limits your upside too, just to be fair. But you know, that's a trade-off for not having 100% of the risk and the upside.
Right, and diversification does that too, right? Like that's diversifying the capital injection, but diversifying across multiple properties can lower risk as well. Diversifying across multiple markets can reduce risk. But that's like sort of 101 risk mitigation, where this asset-specific stuff where you put in real effort can matter. There are other things you can do too. For example, by investing in someone else's deal, you can mitigate your risk dramatically. If you put money into a syndication, somebody else's apartment building where you maybe put in $50,000 and you own 1% or 2% of the deal, that's all you can lose, right? Because you're not signing the personal guarantee. You know, for Brian and I, when we set up those deals, we're generally signing personal guarantees, and if the deal goes bad, we're going to be out millions, right? But the person that put in $50,000, that's the maximum risk exposure they have. No, are they limiting their upside some for that? Of course. Yeah. But
there are trade-offs.
Yeah, and so when we're looking at risk mitigation, I think the real secret is, if you go back to the beginning where we talked about the risk-free rate of return plus the risk premium, it's deciding how much risk are you willing to accept, and then what kind of return you want, and then figuring out how you can reduce your risk relative to that return you want using these strategies that we outlined today. Do you have any other thoughts about that? Or
nope.
All right, then, we will wrap up there. So thank you so much for watching. If you're liking the show, be sure to give us the thumbs up, share it on Facebook, tell your friends, call your grandmother and tell her to subscribe. Do all those things, and we look forward to seeing you next week.
See you then.